So far this Q1 2025 earnings season, it's been kind of a mixed bag for S&P 500 companies. Some sectors have seen gains, others have seen declines, and in light of tariffs, the question becomes what are companies offering for guidance going forward? All of that and more now with our research director, Shiraz Mian. Shiraz, another facet to that mixed bag I just spoke of is earnings estimates and estimates for the next 12 months back about a week ago seem to be in pretty decent shape. But now we see estimates going forward are declining. And now you wrote this morning in your commentary on Zacks.com that tech estimates are increasing again. So what's going on with this estimate picture?
Thanks for having me, Terry. Yes, it is a mixed bag. You are absolutely right. Estimates for Q2 as well as for the remainder of the year 2025 have been coming down, but you put your finger right at something that I'm struggling with as well. And I wrote that in my commentary that while in the aggregate estimates are coming down, tech is showing signs of life and estimates for tech. And this is literally in real time. Since, as you know, Terry, uh, we, we grab all the estimates from all the analysts in the US, and that's one of our core competence. So, unlike others who may be commenting on earnings, we really have our fingers on real time earnings data. And it's the reading of that real time earnings data that's showing that estimates for the tech sector have started going back up again.
So now, in light of that, having talked about that, you've also written that this earnings season is more about earnings impact of the tariff uncertainty on the macroeconomic picture. Is that still the case?
Yes, that is the case. And you you are aware, as I'm sure you are, and our audience is too, that uh, since April 8th, the market has bounced back very nicely. In fact, the market, all the major indexes are now trading at levels that are on par with when the federal government announced those punitive tariffs on April 2nd. And the reason for that is that many in the market are trying to look past the tariffs uncertainty to the period when the U.S., with its trading partners, will have a new updated trading relationships. And as we are recording this, Terry, I'm hearing about a trade deal with United Kingdom, and my sense is that this is the first of many that the federal government would announce, and this fog and cloud that's been hanging over all of us uh, will start lifting. But you're absolutely right. Tariff uncertainty is still with us, and that's a problem for earnings.
So, sticking with that whole uncertainty issue, is negative guidance outweighing the positive this earnings season?
For the most part, yes. Companies are getting a pass, if you will, from the market because all of us can appreciate why they are guiding lower. So if you are a retail operator, if you are an importer of products that are sourced from China or Vietnam or any other country that are faced with much higher tariff levels, it's hard for you as a business to really quantify and share the details with us. Some companies have tried to do that, given a base case outlook and a worst case outlook, but for the most part, the guidance has been negative.
All right. So, what does the scorecard look like right now, as far as growth and revisions and margins and all that stuff?
So, including all of the results that came out today, this morning, we now have 440 S&P 500 companies that have reported results already. That's 88% of the index. So the bulk of the reporting cycle is now behind us. Earnings are up 12.2%. Revenues are up 4.1%, and that by itself should tell you that margins are up. When earnings are up more than 12% and revenues are up more than 4%, that means that almost 8 percentage points of the earnings growth is coming from expanding margins. 73.4% are beating EPS estimates, and 61.8% are beating revenue estimates. The growth rates that we are seeing is roughly in line with the not exactly and precisely, but roughly in line with the level we have been seeing over the last few quarters. The beats percentages, both for EPS and revenue, are on the lower side. So if you look at compare the beats percentages to recent periods or historical periods, we are tracking a bit below those levels, particularly on the revenue side.
So, on the sector level, the big banks and the techs seem to do pretty well. On the flip side, though, energy seem to be having some problems. What are some of the standout sector surprises?
Yes, so you're absolutely right. Energy results have been very weak, both in terms of growth as well as the beats percentages. In fact, less than 60% of the energy companies have been able to beat EPS estimates and revenue estimates. Tech results have been very strong. 24% earnings growth, uh, and more than 85%, 78%. 78% are beating EPS estimates, more than 86% beating revenue estimates. You're absolutely right about finance too. There's a number of other sectors that stand out for good or bad reasons, but these would be I would say the standout areas.
So, overall, published data shows more sectors reporting declines and overall earnings growth below historical averages. Is that worrisome?
So yes, it is worrisome in the sense that uh, that what does it tell you for the coming period? Now, it's it's not worrisome on the other hand in the sense that the first quarter of the year, which these results pertain to, has macro conditions that the market is very well aware were very different from what would prevail in the rest of the year. So expectations and estimates for the rest of the year are getting adjusted lower. But yes, growth on the whole has been problematic for a host of sectors, and that is an issue.
Let's circle back to big tech. Estimates are increasing, as we said a moment ago. But are those big tech estimates too high?
No, it doesn't appear to be, Terry. So for Q1, if we look at it, um, and combine the results that have come out relative to, and combine that with the still to come earnings results. Remember, after May, even the Meg 7s, six of those have reported. NVIDIA still has to come. But if we combine that, Q1 earnings are on track to be up 24.5%, and revenues are on track to be up 11.1%. Now, any way you look at that, that's a pretty impressive growth pace. And estimates for Q1 had come down. Uh, Now, we saw last week and the week prior to that a number of these Mac 7 players, Alphabet, Meta, Microsoft, they came out with impressive results, very strong growth rates. And since Q1 is a subset of the annual number. So when the annual number inched up a bit, my initial assumption was that it's just pure arithmetic. Even if you keep estimates for the rest of the three quarters constant, but increase the Q1 growth rate, that will raise the annual. But when I looked under the hood, I noticed that estimates for Q2, estimates for Q3, have also increased. So my sense is, Terry, and this is an evolving narrative at this stage, but my sense is that perhaps the downward adjustments to tech, as we started seeing since the tariff announcements, may have been overdone. I'm not 100% sure that's the case, but that's my working assumption as I'm trying to make sense of why the uptick in tech sector estimates. So no, estimates are not too high. In fact, on the contrary, they likely had been cut too much, and analysts are now realizing that and adjusting estimates a little bit higher.
So, what is the Q1 earnings profit margin looking like so far? And how does that stack up to, let's say, year ago and 5 year average?
So very decent gains, about 90 basis points year over year in Q1. When we look at the blended margins picture, and what I mean by blended is the 440 companies that have reported, and then estimates for the still to come 60 companies. Now, two major moving parts in there of the major sectors. Tech is really helping expand the aggregate margins, and as you know, Terry, tech is the biggest earnings contributor to the S&P 500, and energy is dragging it down. So when we look at Q1 margins, the year-over-year change is almost full 3 percentage points for the tech sector, which is very impressive. And for the energy, it's dragging it down a little over 1 full percentage point. So tech is a big contributor. Finance was another sector that stayed stable. A number of other sectors that are moving in different directions too, but tech and energy are the major movers for Q1 margins, and tech is helping it stay in the positive.
Analysts have reportedly cut their second quarter estimates a little more than average. So, is the earnings outlook now dimmer for the rest of the year? And if so, just how much dimmer?
So this is an evolving picture, Terry. We're about a little over a month into Q2, starting on April 1st. So yes, estimates really have come down, and what this reversal in the tech sector estimates suggests to me is that perhaps this above average negative revision that we witnessed over the past month perhaps may have been overdone. Now, we don't know, obviously, 2 more months still to go uh, in the June quarter before we get the final picture. But you're absolutely right. Estimates for Q1 really got cut a lot more than we are used to seeing in comparable periods and other recent periods. And a lot of that, I would the reason would be the tariff announcements and the associated uncertainty. And as the fog is starting to lift from that uncertainty, we are we are starting to get a better picture of the ground reality. But yes, estimates for Q2 have been cut far more than we are used to seeing.
So, as long as this uncertainty persists and these cuts persist, do you expect this to be problematic for stocks for the rest of the year?
So it depends how long this uncertainty persists, uh, and what the end picture is. And by that I mean is to what extent these tariffs, the reciprocal tariffs that were announced on April 2nd, make into the final agreements. Uh, We don't know a whole lot of the details of what's been announced with the UK trade deal, but my sense is that the tariff levels were a negotiating tactic by the federal government to arrive at a new trade regime with the partner that's fairer to the U.S. Exporters as well as the importers. So, to the extent that at some future date in the not too distant time, these uncertainties lift, then we will have a truer picture of the ground reality and profitability. But if it persists, yes, it is a problem. Secondly, negative revision is always a headwind for the market and for stock prices. So to the extent that estimates keep going down, that's a negative read on the ground reality of corporate profitability, which is not good for the market.
All right. We want to remind our listeners also that they can keep up with all of these changes in dynamics during the earnings seasons and beyond. In your written commentary on Zacks.com, access it right off the homepage. Changes twice a week, so check back often. With Shiraz Mian, I'm Terry Ruffalo. A small number of under the radar tech companies, speaking of tech, appear poised for exceptional growth, and they are at the forefront of emerging trends that are changing the world and could very well be the big name tech stocks of tomorrow. Zacks is targeting exceptional gains from these stocks over the long term, and you can find out more by going to Zacks.com/promo for details.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.